Welcome to Breaking News to Trading Moves. We are looking at a specific headline regarding Trump Media and Technology Group today.
Yeah, and it is a fascinating one from a structural perspective.
Right, so the core news here is that the company is exploring a spin-off of its Truth Social platform into a separate, publicly traded company.
Exactly. That is the headline you are seeing everywhere. But the mechanics are really where the actual story is.
Because it isn't just a clean split.
No, not at all.
Mm.
It involves a potential merger with a special purpose acquisition company, or a SPAC.
Okay, let's lay this out clearly for everyone. The primary company involved here is Trump Media and Technology Group, ticker DJT.
Right.
And the news is that DJT is discussing a structure to basically separate Truth Social and its related digital media assets into a brand new, distinct company.
Correct. And to be clear on the specific structure being discussed, DJT is looking at a way to distribute shares of this new entity to existing DJT shareholders.
Based on specific eligibility and record dates, I assume.
Usually, yes. But the twist, and this is what makes it complex, is that the new entity would likely merge with a blank check company.
Us back.
Right. So it effectively acts as a de-SPAC transaction.
Okay, hold on. Let me make sure I have this straight. We have DJT, which is already a public company.
Yes.
They want to take a piece of themselves, Truth Social, spin it out, and then merge that piece with another public shell company.
That is the proposal being discussed, yes.
I mean, that sounds like a massive amount of financial gymnastics just to separate two business units. Why not just do a standard spin-off?
Well, a de-SPAC creates immediate liquidity and a highly distinct market valuation. But you really have to look at the broader context of what DJT is trying to become.
The pivot.
Exactly. The report mentions that DJT has been discussing a pivot into fusion energy via a merger with TA Technologies.
Fusion energy, like the actual science fiction power source.
Literally plasma physics, yes. So, look at the portfolio. You currently have a company holding a social media platform and potentially a fusion energy startup under one roof.
Talk about an odd couple.
It really is. Those are two completely different businesses. They have entirely different risk profiles, different capital requirements, and entirely different investor bases.
Right. One runs on user engagement and ad dollars, and the other runs on massive capital expenditure and technological milestones.
Precisely. So the strategic logic here is to split the business into two distinct public stories. You have social media on one side and energy or fusion on the other.
Which brings us to the core question of why the market cares about this structure. Usually when companies split up, we hear about the value unlock theory. Is that what we are looking at here?
That is the working theory. In the markets, we often see what is known as a conglomerate discount.
Where the sum of the parts is worth more than the whole.
Exactly. If investors want exposure to a speculative fusion energy play, they don't necessarily want to also own a social media platform, and vice versa. By forcing them to hold both, you actively limit your buyer pool.
Okay, so if you separate them, the market can price the media business on media metrics.
Right, like sales multiples or daily active users.
And then price the energy business on its own merits? It allows for a pure play investment thesis.
Theoretically, yes. That is the upside argument.
But there's a flip side to this, right? Because this feels incredibly complex for a company that has already had a fairly volatile history.
And that is the counter-argument that traders are weighing right now. Investors might view this as just added complexity. DJT has moved from social media, they flirted with crypto exposure, they looked at fusion, and now they are proposing a spin-off.
It's a lot to follow.
It is. That kind of strategic whiplash can be exhausting for shareholders. It can put real pressure on the stock.
It makes you wonder what the core identity of the company actually is.
And that creates a risk. The risk is that investors view this not as a masterstroke of corporate structuring, but as evidence of constant strategy changes. Or worse, a dilution risk.
Because of the SPAC mechanism.
Right. If the spinoff requires new capital, or if the SPAC merger has unfavorable terms or heavy sponsor fees, existing holders could easily see their stake watered down.
And we know the market hates uncertainty.
It absolutely despises it. But while the shareholders of DJT digest all this complexity, there was a whole other group of market participants who were thrilled by this.
The deal makers?
Exactly. This move reignites the entire SPAC playbook for 2026. High-profile deals like this tend to move not just the specific company involved, but the entire deal ecosystem surrounding it.
Which is a perfect transition to our winners segment. Let's talk about who actually benefits from this news. Because even if the stock chart gets messy, someone is making money on the transaction itself.
Oh, absolutely. The first group of winners are the SPAC and deal cycle beneficiaries, mainly the infrastructure players.
The exchanges.
Yes, when you have a high-profile de-SPAC transaction, it increases overall interest in SPAC issuance. It drives trading volumes up, and it drives advisory activity.
Because a SPAC listing is technically two listings.
Exactly. You have the initial shell company listing and then the new ticker after the merger is completed. That is double the activity.
So for tickers, we are looking at NASDAQ, ticker NDAQ.
Yes, and the Intercontinental Exchange, ticker ICE, which owns the New York Stock Exchange, and Cboe Global Markets, ticker CBOE.
It's just a volume game for them. High volatility and high deal volume are exactly what they want.
It is their lifeblood. If this deal goes through and works out, it validates the SPAC mechanism all over again. You might see other companies looking at this and saying, hey, if DJT can use this to restructure, maybe we can too.
Now, you mentioned complexity earlier as a negative for the actual stock price of DJT, but isn't complexity a product that someone sells in finance?
It is the ultimate product. And that brings us to our second group of winners, the investment banks and advisory firms.
I assume we're talking about the major Wall Street players here.
The heavy hitters. Goldman Sachs, ticker GS Morgan Stanley, ticker MS, JP Morgan Chase, ticker JJPM.
Break that down for me. Why is this specific deal structure better for them than just a standard clean IPO or a simple spinoff?
Because complicated restructurings generate massive fees. You essentially have three complex events wrapped into one here. You have a spin-off, a SPAC merger, and a concurrent pivot or acquisition of a fusion company.
And every step needs paperwork.
Expensive paperwork. Each of those steps requires things like a fairness opinion.
What exactly is a fairness opinion in this context?
It is a legal and financial necessity. The board of directors has a fiduciary duty to their shareholders. They can't just spin off Truth Social and say, well, we think this is a fair deal.
Right, they need outside validation.
Exactly. They need a major bank to come in, do a massive valuation analysis, and officially write a letter saying that this deal structure is fair to the existing shareholders.
And I'm guessing those banks don't write that letter for free.
We are talking millions in advisory fees.
Yeah.
And that is just for the opinion. Then you have the capital markets work.
Right, the underwriting.
Yes. If the new entity needs to raise debt, the banks underwrite it. If they need to register shares or manage the actual M&A advisory roles, the banks handle it. Complexity is highly billable.
So even if the stock price of DJT goes down on the announcement, the fee pool for the advisors is locked in.
Totally intact. The advisors get paid regardless of the trading performance.
That is a crucial distinction to make. Okay, let's look at the sector itself. If Truth Social is spinning off, does that help or hurt other social media stocks?
We see a very clear winner scenario for the established social media platforms, the ad tech and engagement winners.
So companies like Meta Platforms, ticker META, Reddit, ticker RDDT, and Pinterest, ticker PINS.
Correct.
Now wait, I would have normally thought that a competitor, especially one getting a fresh public listing and a new corporate focus entering the market, would be a negative for the established guys.
In a vacuum, maybe?
Mm.
But you have to consider the advertiser's perspective here. Advertisers hate uncertainty even more than stock investors do.
That makes sense. They need to know their campaigns will actually run.
Exactly. If Truth Social is going through this massive multi-step restructuring, splitting from its parent, merging with a blank check company, that is a lot of internal distraction.
You think the sales team might be more focused on their new stock options than actually selling ad inventory?
Or that the technical back end might be in flux during the transition. If I am a media buyer at a major agency and I have a quarterly budget to deploy, am I going to risk it on a platform undergoing corporate surgery?
Probably not.
Right. I am going to rotate those ad dollars to scaled platforms with proven monetization. I'm going to put it on Meta or Reddit where I know exactly what I'm getting.
So it acts almost like a flight to safety for ad budgets.
Yes. When traders decide the standalone outlook for a challenger brand is challenged or distracted, user attention and ad dollars typically rotate right back to the giants.
Okay, so the exchanges win on volume, the bankers win on fees, and the big competitors win by default on ad stability. Let's flip the script and go to the losers segment. Who takes the hit here?
The first loser is the complexity discount bucket.
Yeah.
This is potentially the stock itself, Trump Media and Technology Group, ticker DJD. And the original SPAC associated with it, Digital World Acquisition, ticker DWAC.
You touched on this earlier, the idea that investors want a pure play. But walk me through why that actually drives the price down right now. Why wouldn't investors just hold the stock and wait for the split to happen?
It comes down to institutional mandates. This is a mechanical part of the market that retail traders often overlook. Big pension funds, mutual funds, and ETFs have very strict charter rules.
Rules about what they are allowed to own.
Exactly. Say a clean energy ETF wants to buy into the fusion story. If that fusion story is legally tied to a social media platform inside DJT, their charter might outright forbid them from holding the stock.
And conversely, a communications services fund can't justify holding a plasma physics company.
Right, so by being this hybrid mashup, you alienate both major institutional buyer pools. You are left with a much smaller pool of investors who are willing, or legally able, to hold the combined asset.
And lower demand means a lower price.
Until the separation is 100% complete and finalized, the stock often trades at a discount due to governance and strategy concerns.
Which brings us to the second group of losers. You have this listed as high volatility retail momentum names.
Yes.
So we are talking about GameStop, ticker GME, and AMC Entertainment, ticker AMC.
Correct.
I have to be honest, I struggle with this correlation. Why does a corporate restructuring announcement for DJT affect a movie theater chain or a video game retailer? They operate in completely separate universes.
Fundamentally, yes, they have nothing to do with each other. But mechanically, in the market, they are heavily linked because they're often owned by the exact same people. It is a concept called liquidity correlation.
Okay, break that down for me. How does that work in practice?
Imagine a retail trader who holds DJT, GME, and AMC in the same brokerage account.
A fairly common momentum portfolio?
Very common. Now, if DJT announces this complex multi-step deal and the market reacts negatively, say the stock drops because of the complexity discount we just talked about, that trader's portfolio value drops.
They might get a margin call.
Exactly. When a story stock becomes a multi-step transaction, the probability of delays, amendments, and dilution rises. Momentum traders often exit quickly in a risk-off tape. Or, if they get a margin call, they are forced to raise cash immediately.
So they sell their other liquid assets to cover the call.
Right. They sell GameStop, they sell AMC. It isn't because GameStop announced bad earnings. It's purely because the trader needs liquidity.
Wow, so they're essentially used as an ATM to fund the losses in another trade.
It is a contagion effect based entirely on the shareholder base, not the underlying business.
That makes total sense. Now, looking at the third group of losers, you actually have Pinterest listed here. But we just talked about Pinterest as a winner in the ad tech space.
Yes, and this is where market nuance is really vital. Pinterest, ticker PINS, and Snap, ticker SNAP, are in a very tricky spot here.
How so? How can Pinterest be in both buckets?
Because of the angle you view them from. If the news pushes investors toward the idea that scale wins in social media, which is the flight to safety argument for Meta, then being a mid-sized player is suddenly a dangerous place to be.
Ah, I see.
If investors look at the DJT spinoff and decide that operating a standalone social platform is just too difficult or capital-intensive for anyone but the absolute giants, they might start selling off the mid-tier platforms out of caution.
So Pinterest might win some marginal ad dollars from the disruption, but they could lose on overall investor sentiment.
Precisely. Smaller ad platforms can experience multiple compression. That means their valuation drops relative to their earnings simply because the market is assigning a higher risk premium to the entire mid-tier sector.
It is a really tough neighborhood to operate in. Okay, so we have the full layout. DJT is trying to split the atom in its corporate structure at the same time. The banks are billing hours, and the retail traders are managing their liquidity correlations. For the traders listening right now, what is the checklist? What should they watch for next?
The absolute first item is confirmation.
Because right now, this is just a report of discussions, correct?
Right. It is exploring a spinoff. Until we see a definitive agreement actually filed with the SEC or a formal no-deal update, this is just noise. The market will be waiting for that formal confirmation.
And once you get the details, what are the red flags to look for?
Valuation and ownership splits. We need to know exactly how the shares are distributed, what the shareholder eligibility is, and crucially, the lockups.
And I imagine liquidity is a major factor there, too.
Massive. The core question is whether either the new standalone entity or the remaining entity needs to raise cash immediately after the split.
Because if they are born starving for cash, they have to sell stock.
Right, which goes right back to the dilution risk we discussed.
What about the timeline? How does this align with the fusion deal?
You have to watch how this aligns with the TAE transaction. Regulatory bodies move at their own pace. If the fusion deal hits a snag, does the media spinoff get delayed? Traders need to monitor the timeline of both parallel deals.
And finally, the scorecard.
Yes. The market will force a standalone scorecard for Truth Social. Once it is stripped away from the fusion narrative, it has to stand on its own 2 feet.
Which means real, hard metrics.
Guidance on user growth, their ad stack performance, subscription models, and average revenue per user. The market will judge the standalone entity strictly on media metrics.
So the value unlock theory will be tested immediately against the reality of quarterly earnings.
Without a doubt.
It is a compelling case study. You have a company trying to house two radically different futures, realizing the market might not digest that well, and attempting a highly complex corporate divorce.
While simultaneously paying a lot of advisors to make sure the math works.
Which leaves us with a final thought for you to consider. We so often hear about the nature of pure play companies versus conglomerates. Does splitting a social media platform from an energy venture actually clarify the investment thesis? Or does it leave the standalone social entity too exposed to market scrutiny without the broader futuristic fusion narrative to support its valuation?
It is the ultimate question of whether focus is rewarded more than ambition in today's market.
Something to mull over as we wait for the actual filings to hit the wire. Please remember that this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Thanks for listening, everyone.
We will see you next time on Breaking News to Trading Moves.